I want to talk a little bit about the product before we get too much further. And really, interest rate caps are essentially call options on LIBOR settlements, interest rate floors. They're just put options. So for those of us that have traded in the commodity markets, or if you've traded in the stock market and had any exposure to options, a lot of this is just a terminology difference. So a cap is a call and a floor is a put. So they, just like any other options, they can be bought and sold. There's a single upfront premium, and these caps, just like swaps, can be set up to perfectly match loan terms out to 10 years. Using 1 month, 3 month, or 6 month LIBOR settlements. Most commonly, we use 1 month, and so the idea is to just like a swap, is to set up an interest rate cap or an option strategy with the same terms as either an exact loan, or sometimes it's a portfolio of loans, and that sets a minimum and a maximum interest rate. The only real difference between caps and floors and the more common commodity options that we're used to is that typically a commodity option is going to have a single settlement, so there'll be a single upfront premium and a single settlement, whereas an interest rate cap, for example, has many settlements, because each month when interest is due on the loan, there's going to be a corresponding settlement on the interest rate cap or floor that's essentially setting a minimum or a maximum rate on what that total amount of interest is going to be. So key difference, but it's still, all of the strategies that we use in other markets are very applicable here. So a couple key things, especially as we talk about going from commodity options or stock options into long-term interest rate options, they have a lot of time value. So one of the things that we try to do with the strategy is to utilize, how much value out of the money options have. I think that when you see how much you can trade a spread for versus an outright cap, the spreads start to look really attractive, especially when we're selling it pretty far out of the money. And again, going back to where we are in the market, where we see a clear path to maybe 3.5% or 4% LIBOR. We could get to 4-quarter LIBOR if things keep firing within a few years. But you start to get comfortable maybe selling a 4.5% and maybe having protection from 3.5 to 4.5 and different strategies like that give you a limited amount of protection by taking advantage of some of the time value in selling options as well as buying them. So balanced strategies, they limit some of the risk in the short run. Obviously with a swap, the market value of the swap goes up as rates go up, and it goes down by the same amount as rates go down. And so by doing a more balanced strategy of buying and selling some options, we can really limit the amount of volatility risk and potential liquidity risk that we see in swaps, lower margin, obviously. And then the other thing we use options for is to enhance existing swap positions. So similar to having a long portfolio of stocks, and a pretty common strategy is to keep that portfolio of stocks, but to sell a covered call. Many of our customers that have, good hedges on, that maybe they put on in 2016 that are way below current market rates, they have a huge mark-to-market gain on that swap, and they want to keep the swap. They're happy with it, but you might say, okay, I don't see LIBOR going above 4.25, so maybe I'll sell the 4.25 cap and collect some premiums.